Alright guys, welcome back to our 2025 lecture series, the beginner guide to trading. So today we are going to be looking at a simple concept called internal range liquidity. So as we had seen in our past video, we looked at the external range liquidity, where we looked at the equal highs and equal lows, and I think we looked at how it can vary in various ways, and then we are going to be looking at internal range liquidity. Then we shall later venture into time-based liquidity. So for internal range liquidity, this refers to areas, like I would call these areas, that have clustered orders within the trading range. So I remember we talked about this in our first videos. I remember what the trading range means. I remember talking about that. If you didn't watch that, you can go refer to that. So suppose we have this bit of market structure. So in this bit of market structure, this is our dealing range from this low to this high. So we have certain factors and certain points in price action that happen to show us where certain orders or a certain number of large orders were instilled in the market by the market makers at a certain price level. So back then, actually not back then, because this thing is still being used, but in trading venues when it was still popular, like those Wall Street, before people got access to, because now everyone can access the market on their laptop, but back then you used to have to trade at a trading venues like Wall Street, or like particular stock exchanges. So they had something we call an order book. So an order book, what is an order book? I don't think we need to look so much into this, but for understanding. So what I mean by internal range liquidity, these are specific points in price action. So what I mean by that, those specific points are called altogether are called PDRs. I think we have heard of me saying something of this sort. So PDRs stands for premium discount area. So this P stands for premium, then this stands for discount. This is discount, and then this is premium. I hope this is fucked up. This is premium. So these premium discount arrays, these are certain factors we base on to know where orders in the market were punched in, because you're not going to be having numbers on your chart. Find their indicators, like their volume indicators and stuff, but I don't. In our trading, we are going to be working with pure zonal trading. We won't be needing anything, and you can see the indicators I have on my chart. This is the new week opening up, and the opening up, then this is the watermark for this, for my name. That's all. We won't be needing anything. We shall be working with the price action that is provided to us by the market, then we'll take trades. So PDRs, there are various types of PDRs. They are fair value gaps, don't mind me talking like someone who is tired. I'm just from the gym, been working out, it has been so intense. Fair value gaps. We have order blocks. We have if we are to look at PDRs, we have something somewhat close to 82, 81, around there. We have volume imbalances, and so on and so forth. So we shall be looking at mainly fair value gaps, order blocks, and volume imbalances. In this trading, space. You don't need to be knowing everything. Actually, I think a lot of information can kill someone's trading, or lengthen the period that would have been a short period for them to become profitable, and they are stuck in a process of studying. If you want to learn everything, you're going to be like a dog in a meat market. Like you, as ICT says, you're going to be like a dog in a meat market. You want to eat a bit of everything. You're not going to get satisfied. You won't get full. You won't get pleasure with. You won't get content with what with what you're eating, rather than someone who has been given a piece of steak and they are full and everything is sorted. So you shouldn't be in such a way. You should get a certain way of trading, a certain mode, call them systems. You should get a certain system you follow, and you say that I'm working like this, nothing can put me off this, no matter how you see someone took an entry, because everything is the same. There is no entry someone is going to take when you cannot take it, if you follow closely. So we have also another form of liquidity for or call internal range. We have the new day opening gaps and the new weekly opening gaps, but we shall look further into those because that is a bigger concept. So premium discount average, I remember we talked about if this 0.5 is our fair pricing, so above fair pricing this is premium, and then below fair pricing that is discount. So if we have an array that is in premium, that is a premium array, and then if we have something in discount, that is a discount array. So that is it. So I was still talking about an order book, sorry for that. So an order book is a list of orders. It doesn't have to be electronic as people say, because this, I don't know, people are so caught up with electronics, I don't know why, but it doesn't have to be electronic. It can be also manual. You can draw your order book like basing on certain things, quantitative analysis, like those sets on budget.com, things like that. I think I talked about that in our first lecture. So this is a list. I would say it is a list of orders that a certain trading venue or stock exchange uses to record the interest of buyers and sellers in a particular financial instrument. So suppose we are looking at Nasdaq. So the order book is something used, whether electronic or what I mean by electronic, it can be automatic, like the values of the orders are punched in automatically, or manual, or like someone puts them in. So it doesn't have to be just electronic. So it is just a list of orders, like it shows how many sellers and how many buyers. Of course, they're not going to be showing you like the small speculators. You know that everything we have are traders, all traders in the world, even those that move millions, are among small speculators. The large speculators start from banks, and then we have the market makers above them. So the small speculators have no say about the market. So these orders are mainly for the large speculators because they lead to movement of the market. So this thing is a list of orders that shows it is used to know the interest of buyers or sellers in a financial instrument. Take an example of this Nasdaq. We are looking at these features. So this order book will be showing, it will be in some sort of this way. We shall be having two columns of, this is going to be just a rough copy, like just for explanation. So we shall be having bid and ask columns. So bid is the represents buyers, and then the ask represents sellers. So it depends. it depends on who has the majority of the number of orders in the market. So if the buyers have the majority of the orders, then the market will follow the direction of the buyers. If it is the sellers, then it's also that way. So suppose we have, and mind you, this thing that I have drawn is for a particular price, like how you see something this way, like 24140. This is for a particular price. It shows the number of orders right there. So suppose we have a price level. Okay, if we have different price levels, so if this is for 24140 right here, and we have let me see, we have something like 100, and it is versus 50 right here, something like that. But what I want you to know, like this internal range liquidity, it is a cluster of orders, like where the majority of orders lie. So suppose we have a price level which has 1,000, we came having 150 and stuff, then we come across a certain level that has 1,000 with 200. So this 1,000, this is a big order, this is a big number of orders. So suppose below this we have 100, and so on and so forth, something like that. So if market moved from this way and followed the buyer's direction and bought, then if market makers, let me take an example of this. If market moved from this way down and buyers punched in orders that were enough to sponsor a move higher to a certain price level, which is let me put the prices on this fib. Yeah, so if they manage to push price and sponsor and put orders in the market that can sponsor a move from 23891.5.75 and push it to 24111.75, and the orders that were enough to push this move are exhausted, these guys will want to generate more income. So take it as something or a car. So it moved from A to B. Let me take an example of this being A and this being B. If they manage to put fuel in this car and it moved from point A to point B, then the fuel ran low, then they will have to add more fuel. And in the market, money is the fuel. Like other people that are on the wrong side of the market act as fuel for the market. So this market will want to trick some buyers to get out of the right buyers and trick sellers into selling this market. So we shall look at that later. But if they put in orders that are enough to sponsor a move to come back to pick the price point, which had a large cluster of unfilled orders, so this cluster had 1,000 unfilled orders, and if market can come back and drop into that level to pick up these orders as fuel, then continue in the direction in which it was going to. So that is actually basically the criteria of the internal range liquidity. So these are areas where a lot of orders were punched in. So these orders will act as fuel for the market, just in case the market makers don't have enough fuel to sponsor the next coming move. I hope you understand. So the mechanics of all these PDRs is that market has to come and pick the unfilled orders in them and continue in the direction it goes to. We shall see what happens if the market violates and continues lower. We shall see what it means. If it violates any of these and continues lower, that's where we get inversions. So we get inversion fair value gaps, and those will be used more so in models. But for volume imbalances, these have a room for error. Like they are not so perfect. So we can allow market to pass through them and come back up following the same direction. So order blocks and fair value gaps, these act as the same thing. They are different things but act as the same thing. But if a fair value gap fails, then it becomes an inversion fair value gap. If it fails, like market, these sellers here that had to sponsor a move lower to come pick these orders that were unfilled happen to punch in orders that can satisfy all these orders and continue pushing it in the direction in which it was coming. That means market will just drop, pass through the PDRA, and then use it to continue in the opposite direction. So that's how the inversion works. That is in the criteria behind internal range liquidity. So in our next video, we shall be looking at one by one. We shall look at fair value gaps alone, then we shall look at order blocks, volume imbalances alone. We shall have some chart examples, and I think within 2 weeks time, because I think I'll be having school, but it is fine. I'll get a way of doing it. Within 2 weeks time, we shall start doing live trading. We shall be trading live the New York session, or the New York session, the AM session, or the PM session. We shall be trading live. So make sure to turn up, make sure to come and watch. And this is not to sell any course or something. This is for educational purposes only. So until next time, thank you guys for watching. Enjoy your night.